There we go. All right. Now we're freshly recording. So I appreciate you taking the time, to come join us for this special session of the Money School Essentials event to talk a little bit about, what you see coming. I get your newsletter. I'm, one of the paid subscribers to the newsletter. I swear I get every one of those newsletters and I stop everything. I read the whole thing. It has been so spot on. And literally even right down to the Bitcoin stuff, which I'm like, well, I don't look at, Harry Dent Jr. as being an expert in Bitcoin, but you're not an expert in Bitcoin. You're just an expert economist. And I don't know, I get so much joy out of all the stuff you put out. So thank you for doing that. And I know you got, an offer for everybody on here, but listen, the floor is yours. I know, we've got a limited time with you, but whatever you want to talk about, I think it's great. I'd most like to hear about what is coming, like we all know something's coming. It doesn't look good. Something stinks out there. What is it?
Well, we are in the greatest bubble in history. We've never seen a bubble across all asset classes, so global. And all I hear from most economists and commentators, well, this isn't really a bubble because of whatever. That is so typical of bubbles. People get high in bubbles. When stocks go up this much year after year, real estate goes up this much year after year, you're sitting on your you-know-what, making money doing nothing. What's not to like about that? The problem is they're not real. They start real, and this one is the ultimate, Chris, because this boom, I was predicting back in the early to mid 80s that we'd see the greatest boom in history with baby boom spending that nobody saw coming in such a large generation. But in 2007, that peaked right on cue, and we've been living off of money printing, just printing money out of thin air, and that money's not going into the economy. The economy's been growing 1.6% average since 2009, the worst growth in all of history, and yet we got the strongest, bubbliest, greatest stock market advance in history in this very weak period. It's because we've been living off of printed money while the baby boom generation spends less and less just to get people to spend a little more. And then what we really have is a 4% plus growth economy for the affluent, the top 10 to 20%, and a zero growth for everybody else, Homer Simpson and the other 80%. And that's not healthy either. So what I'm seeing here, and this is coming a little late on my cycles because so much stimulus, I think stocks are peaking this year. I think it could be happening now, or it could happen by early June in the near term. And at the very latest, later this year, I think it's most likely happening now. This thing has gone up and up and up. Now we have interest rates rising and inflation late stage. And that's the type of things that work against this. But again, what we've had is exponentially more money printing, but something called money velocity, how much the money is invested and profited from and reinvested has been going straight down opposite. This is like the jaws of death, to have money velocity collapsing and money supply going up only because of money printing and then getting this lousy 1.6%. So I think it's a great time to sell stocks. It is a great time to get into alternative investments, things like you're talking about. It's a damn good time on the safest thing you can buy is a damn 30-year treasury bond. People say, oh, the dollar is going to crash. No, the dollar is the best house in a bad neighborhood. We're not a good house, but we have printed a good bit less money than Europe, way less than Japan and China, and their total stimulus. They don't print money, they print condos. They just build stuff for nobody. That's the worst thing you can do for an economy and business. So we're going to have, first of all, when this bubble peaks, it's going to be a deflationary scenario. Consumer prices are going to fall, all financial assets, real estate, stocks, and whatever's gone up the most, the stocks or the real estate, the more it's going to fall. Is Omaha going to fall much? No, because nobody wants to live there except for Warren Buffett, okay? But New York or Miami, where I just came back from, or California, the greater the bubble. I tell people in real estate, what was it worth in the last downturn around 2011 to 12? That's the most likely target, and it's going to be lower than you think. And at the worst case, what was it worth when the bubble started back in 2000? And stocks are going to go down 65 to 70% at a minimum, and maybe as much as 80 or 90, like 1929 to 32. Now, again, nobody expects this. Oh, the government won't let it happen. The Federal Reserve, central banks won't let it happen. These are the ones pumping up our economy. They are shooting themselves in the foot. The more you pump up, and I don't care what balloon you have, there's a point where it'll pop, okay? You keep blowing it up. They're the ones blowing it up way against the reality of a slow economy. And they're the ones setting, so it's gonna have to burst. And let me put the most important number in the world economy. And I've probably got to look this up, it's probably 10 trillion higher. $525 trillion in financial assets, real estate, stocks, bonds, that sort of stuff. Now, the more important ratio is that 6.5 times global GDP of about 80 trillion, okay? So it's normally 2 times, okay? Maybe 3 at a stretch. So it's gonna be the collapse of this 525 trillion that is gonna particularly make who feel less rich? The rich. Homer Simpson's gonna lose their job, some of them for a year or two or so, but the rich are gonna lose the most wealth since more than 1929 to 32, because we have so much more wealth per capita, and it's so much more global now. Not just the US and Europe. China's got wealth. Southeast Asia's got wealth, on and on and on, even India and Africa and stuff. So this is going to be what I've been calling for a long time, the crash of a lifetime. The strategy is extremely simple. Get the hell out of the way of it. If you're really slick, you can short it or buy some options, but the biggest thing, just get out of the bubbly assets and get into things that generate predictable cash and cash flow and income. That's the trick. And there aren't many things. High quality bonds, things like you're doing, things that will generate income in a time where this financial asset bubble is collapsing. That's where you continue to grow your money so that when this bubble collapses, the world is your oyster. You're going to buy any financial asset you want, any business you want to take over, any real estate. You know, you should have your sights set on now what you really want to buy the most long-term for your life, for your investments. And again, protect your money now, make solid income and opportunity, and be ready to pounce somewhere between late 2022 and 23. That's when I see a bottom. I have cycles galore, but it's a hierarchy. I know a lot of cycle guys. I don't even listen to them, frankly, because they don't have them in a hierarchy. You have to understand which cycles are most important and what's the domino effect. I got my 4 biggest cycles all pointing down into late 2022, and only one, actually a 5, pointing up gently. That is the most likely time for us to see a bottom and maybe a hangover after that into 2023. Now, from there on, you have the next global boom. Now, here's the other secret, other important. Number 1, don't listen to economists or your financial advisor. Most financial, okay? They're just not going to see this coming. It's not acceptable, and it would be bad to even say it. Well, somebody has to say it, so it's me, okay? But you know, the number 2 is the next boom is not going to be like this boom. It's not just going to be, say, Bitcoin and blockchain instead of the .com and internet companies. That's one thing that's going to change and be unbelievably profitable. I think you're going to see Bitcoin back down maybe as low as 4,000. That is when I would jump on it, okay? But it's going to be the whole, China has been the star, and East Asia, South Korea, and Japan early on of this boom. Yeah, America's done great, Europe, but we were already rich, okay? They became rich, developed countries. Well, this is going to happen in Southeast Asia and South Asia, which includes India and Pakistan. That's going to be the center of the next boom. And for any lucky people in Australia, I sell more books per capita and speak more relatively in Australia than anywhere else. These people have the strongest demographics in the developed world, where most people are either moving sideways or down for decades to come. And they're right on that Pacific Rim where all the action's going to be. In fact, it's not my favorite city, I hate to say it, in Australia, but Perth is the city that's sitting there. It's the smallest city, growing the fastest, sitting there the closest to Southeast Asia and India, where the action's going to be. So there's huge opportunities, but the important thing is people just have to realize things have been too good too long. In other words, this boom, already the greatest boom in history, should have peaked in 2007, okay? Well, when it went down so bad, and when 2008 started to look like 1930, and it was, and I was predicting the beginning of a Great Depression then, they pulled out the guns and money pumping unlike anything even the most liberal economists would not have seen. And I'll tell you, when I added up, just since what we call the repo crisis in late 2019, when they just tapered the stimulus and said, oh, it's okay now. Oh no, the market started to fall apart immediately. Oh no, crack daddy, I'm gonna fall down and go through withdrawal. So since late 2019, and then the COVID smack, which was hit by massive stimulus. If I add up all the monetary stimulus and all the fiscal, including the present infrastructure plan that's slam dunk to pass soon, 55% of our GDP in the United States. That's how much stimulus we've done in a year and a half just to keep growing at an average 1.6%. Oh yeah, we're growing at 6% this year. See how long that lasts, okay? The baby boom is moving into its slowest cycle between 2020 and 23, and then the millennials will bring this out. That'll be a real boom again. So what we have to do is let these financial assets go down. We need them to get down to reality. Otherwise, younger people, millennials, and younger people buying real estate don't have a chance. Real estate is twice what it should be in most areas, and way more than that in others. Stocks are way overvalued. So we need to reset the whole financial system, get all this excess, unproductive investment. And again, I'm gonna end here with a summary. But Dr. Lacey Hunt told me, he used to speak at all our conferences, the only really good economist out there. Money velocity is how productively we're investing our money as a nation. Are we getting, if it's going up, we're getting good returns, reinvesting and getting returns again. When it starts to go down, we're getting lower returns and we're moving into more speculative investments. What's more speculative right now than buying overvalued real estate and stocks that have now gone up since 1983 for 4 decades almost? This is the most overstretched boom. So you have to get out of the way. If you just sit in cash, but again, it's much, much better to find a sound way to generate income or to be in high quality bonds that not only give you some income, but appreciate because they become the safe haven. And everybody's telling you get out of the US dollar. No, you get out of every other damn currency if you're in it, except for maybe Australia or somebody. It is Europe, Asia, China, all these, Japan, all these currencies are going to do worse. The US dollar is a good place to be in. And if people are foreign in Canada or Australia or UK, where I also speak, I tell people I'd be buying the US bonds and income generation investments rather than in your own country. So everybody thinks we're in the worst country. We're not. We are a big part of this bubble because we're still the leading country. But China is the epitome of this bubble. And China is going to go down the hardest. And I just saw a great article. I mean, China, if you look at it, they are going to struggle to grow 2 to 3%, a normal thing in the future after they see real estate go down 50 to 80%, while we maybe see 30, 40, or maybe 50, okay? They're going to get hit the worst, and it's going to shift the growth to the rest of Asia. So it's an exciting world to me. What's most exciting to know that you actually make the most progress. Now, only the smart money knows this, okay? The smart money knows that fear outruns greed. Okay, greed, we've seen greed, greatest bubble in history. Fear happens faster. Bubbles burst in half the time it takes for them to build, and they burst faster. And so the downturns are where you get the most leverage by just generating even modest returns or appreciation when all our financial assets are going down 40 to 50% for real estate, 60 to 90% for stocks, and on. And junk bonds. You're going to be able to buy everything at the sale of election. In fact, I remind people, if you would have just started investing, if you were a moron and started investing in late 1932 or late 74, or late 82, the three big bottoms of the last 100 years. If you just started investing there, and Warren Buffett really got serious there in the mid 70s. You just started there and been an okay investor, you would have made unbelievable returns because you got in the sales of a lifetime back then. So I say that's late 2022 to maybe early 23 in stocks. And then the good thing about real estate takes longer to bottom. Stocks bottomed last time, early 2009. Real estate didn't bottom until 2011, 12. So there are different things at different times. And again, people should listen to people like you that say, look, we know how to generate cash and cash flow. That is what does well in a deflationary down, not an inflationary. The 70s peaks and downturns were an inflationary environment. This is a deflationary environment. In fact, when it really comes down to it, the reason they're printing more and more money, they are fighting deflation. So income, cash, and cash flow is what does well in a deflationary environment, and getting out of all, especially bubbling financial assets. So I know this sounds a little daunting and stuff. This is the opportunity of a lifetime. If you see it, it's the kick in the ass of a lifetime if you don't. And I'm telling you, 90-some% are going to get the kick in the ass, because I just see it. Even now, it doesn't matter how bubbly this market gets, the experts and the politicians come out and say, oh, it's not really a bubble if you compare it to donkey sticks or something, or it's really not, blah, 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 or we're going to cushion this. There has never, ever, there is, I tell you, been a bubble anywhere near this magnitude that did anything but burst rapidly and horribly. There are no soft landings to bubbles like this. And if this is the first one, then I'll be shocked, okay? But I'm not betting on what history's told me. It doesn't matter what's causing the bubble or how much it's supported. In fact, I was in the Middle East speaking, and somebody said, oh, yeah, we've had this big bubble, but the government will buy. The government will not let it burst. I said, well, that makes me more scared. So again, when bubbles get stretched this far, they burst, and you've got to get out of the way. That's my message. Get out of the way and be planning now. Planning now where you want to invest your cash and cash flow that you accumulate in this downturn while everything goes on sale. Because again, what's better than a 50% sale? I'd say in general, financial assets in general are going to go down closer to 50%, and stocks usually 70 to 80.
Well, Harry, one of the things I learned from your newsletters and all your talks you do on the paid subscription one, but Dr. V is on here, and he was saying, what do you think, I think a lot of people are just wondering why, what do you think of the 2 trillion stimulus, 2 trillion infrastructure, 2 trillion American family plan? It's $6 trillion and climbing. Like, why are they continuously pumping this up? Like, what is the end goal for why the government's doing what they're doing?
Well, they're scared to death, Chris. They have already been pumping up more than anybody would have thought. You got to remember, economists and politicians thought when the 2008-9 crisis hit, they didn't see it as a long bubble peaking. They didn't see it as the largest generation in history peaking in their spending and slowing down for a decade and a half, okay? For what it was. They just thought, oh, this is a crisis, and if we just put in enough money and get over this cliff, we'll come out and we'll be normal again. They don't get what happened. So they're frustrated and they're scared to death because they keep upping the ante and they keep having to turn around and do it again. They're scared to death. They just can't tell you they're scared to death. What? I mean, this stimulus is so out of whack compared what even would be normal to help a sluggish economy. It just shows how scared they are. They've done this now time and time again. And we always end up now another pattern in stocks, which only happens. I love it because most people don't see it. It's obvious, but they don't see it because it only happens at major long-term tops like 65, 68, and 72. The stock market went to slight new highs each time, but every time it crashed, it went to lower lows. That is telling. That's what we have here, especially since beginning of 2018. Stock market is telling you, yes, the momentum's still there because people expect stocks to go up and want investment to go up, and they keep buying the dips, but every time it crashes, it goes to lower lows. And that's telling you the economy is failing get out of the way. Every time it goes up, you need to be getting out of the way. So that's just, they're scared, and they should be scared. I would, I would not want to be Joe Biden. I think he's a kind of a nice guy, pretty moderate guy, okay, compared to whatever options, which weren't much, but I would not want to be walking into this. It's okay if you're Barack Obama and you walk in and the recession's already damn near over, or FDR, Theodore Roosevelt. He walked in March 33. That was the low of real estate and the high of unemployment. And several months after the stock market hit the lowest levels ever, he could have been asleep and drunk, and I think he kind of was.
Probably was.
And been a hero. I mean, but he did a lot of these sort of infrastructure things. That was more appropriate back then. They're doing stimulus on that. That was just the beginning of a stimulus program. We're now 12 years into nonstop money printing, and now a bunch of fiscal stimulus on top of it. And between the money printing and fiscal stimulus, I would take the fiscal because it does something more real, but the fiscal requires you to have your government debts go up when they're already skyrocketing. Imagine how big now, just in the last year, we had a probably $3-4 trillion deficit when the economy's still, off and on booming a bit. Wait until we go into a deep downturn and see what those deficits could be. What if there's $5, $6, $7 trillion a year? And I've been forecasting, Chris, for years. On a simple cycle, our federal debt has been doubling every 2 administrations, every 8 years politically, okay? I said by 2025, 26, it's gonna be 40 trillion. People say, Harry, that's impossible. Oh no, it's not impossible at all at this point. The deficits we're running and could run in the next few years. I think we're gonna be 35, 40 trillion dollars. So there's a point where it just gets ridiculous. And it finally comes to an end.
That is.
You get rid of a lot of bad debt and bad companies. I call them zombie companies, which is 20% of not small businesses, more publicly traded companies cannot pay their debt service. They're already failing even in a propped up economy. Wait till the economy fails and see how fast these companies just fall apart. How are you going to stop that avalanche? That's what I say. Everybody, the government will stop it. That's what they told me overseas. Oh no, the government won't let this happen. You can't stop an avalanche once it starts. That's what this is going to be.
Well, a lot of people, when they hear this, we're in a state of mindset. I call it euphoria or FOMO. Everybody thinks they're missing out because everything just keeps going up, and they think, oh my God, I'm going to miss out. But like some people especially the people listening here, because this is all I ever talk about, are thinking, okay, well, if this is coming, like, first off, when do I get out? You already said that. Now is the time, like my watch says. But where do they put their money? How much what percentage goes to cash? Like, where you said U.S. Treasuries. Why U.S. Treasuries? If I'm worried about like cash because my money's not going to pace as they devalue it, like, what do I do? U.S. Treasuries only are paying what? 2.
Well, a 30-year is only paying you 2.3%. A 10-year is paying you what, 1.5 or 6. Okay, people are like, why would I buy a bond paying me 2.3%? Here's why, Chris. I've already done the calculations roughly. If that bond just goes from 2.3% down to my projection of about 0.4 to 0.5% for the 30-year and 0 or less for the 10-year, and plenty of government bonds have already done that around the world. So anybody said, well, that's not possible. That's a 40% plus capital gain on top of your measly 2.3% interest. If you can sit in something as safe, and do you think the U.S. government, if they're going to print money in anything when they blow up, if they're going to pay anything, they're going to pay those damn treasury bonds. That is their credit, and they're already going to be in question. So that's the safest investment in the world. And I still say the best currency outside of maybe a Swiss franc or something, and that's too small. So you make 40% in a safe investment, a safe haven, I call it investment. And then you turn around and buy all the riskier assets when they're bottoming, higher yield bonds, stocks, real estate, and again, I want to buy in the best areas, the swankiest areas, back in Manhattan, back in Miami, San Francisco, places like that. So that's all it is. This has gone so far. The rubber band has to go the other way. So it's just a matter of seeing that, and it is hard to time. Okay, I say right now, all things considered, this is the best time to pull out of stocks. That safe haven treasury bond, I'm waiting a little bit. I'd like to see the yields go a little bit higher on this inflation curve. The TLT is the one that buys an average 20-year treasury bond. It's an ETF. If that gets to a new low below about 132, 133, I'm going to be giving a buy signal for that. I'm telling people right now in the latest newsletter, this is a good time. It may not end up being the best, but boy, the next crash, I should have said this earlier, there's a big topic in the May newsletter. The next crash on this megaphone pattern, which is incredibly clear, looks like 49 to 50% in 2 to 3 months. So I say get out now. I don't want to take the risk of getting hit by that just to get and hold on for another 5 or 10% on the upside if we even get that. So it's a damn good time to get out of stocks, and we're very close to a good time to get in those safe, high quality AAA corporate bonds and the US Treasuries. I really don't like anything else because even the Australian, which has the lowest debt, developed countries and the best demographics, they're still going to get hit when the dollar goes up and all other currencies go down. And that's exactly what happened in the middle part of the 2008 crisis, okay? When stuff got really bad and Lehman Brothers was failing and all the gold bugs said, gold's going to be your safe haven and the dollar is going to crash. No, gold went running for mommy and the US dollar went the exact opposite direction. Gold was down 33% in a matter of months and the US dollar was up 28%. And so if you're in a treasury bond, like I'm talking about, with the yields falling, you'd be up probably 40%. So that's what you do. It's not complicated.
Yeah. And, you know, this morning, you know, at the beginning of this training, and a lot of people maybe didn't see it because they didn't jump on, I was playing a video all about, if somebody looked at Warren Buffett and Berkshire Hathaway and what he's doing, and he's selling a tremendous amount of his holdings from the guy who never sells anything. We buy stock and we never sell. You know, that's Graham's methodology. They buy what they love and they hold it forever. So why is he selling all these stocks? And it was a tremendous amount. It's
well,
because,
you know, the good thing about him, he's very systematic and he buys value. There is no value in a bubble like this. There is no value. That's why he's selling, because he can't find anything that still has value to buy, and then therefore it means you should be selling. Now, he knows now, he's the guy that everybody trumpets around and says, hey, I know it looks like we're crazy people just printing money out of thin air with magic wands and hoping the economy grows again. But Warren Buffett says it's okay, okay? So he's not broadcasting he's doing this, but you're right. He is selling a lot more than he's buying, and it's simply because he does not see a stock crash in the magnitude I do. I guarantee you that. But he buys, he has a discipline of buying stuff that has value that could grow in the future. And there is none.
You know, and it's like we talk about some of the safest financial institutions and what they do. And I'm definitely not talking about banks. I'm talking about giant mutually owned insurance companies, which have historically hundreds of years relied the bulk of their money in US Treasuries. And it's never served them wrong. And they're pretty darn smart because they invest for 100 years in the future, where, you know, the average person's investing for next year or 5 years when they retire. So you know, and I actually just looked, you know, big ones like the Mass Mutuals, the Lafayette's, like they're buying more treasuries right now with people probably think they're insane. They're buying treasuries at 2.3, yet they're guaranteeing 4. Like, are they idiots? Did they not know what's going on? But like, they know exactly what you just said. They know how bonds work inversely to what is about to happen.
Well, but also though, by their nature, people depend on them. I buy a life insurance policy. You better have that damn money when my husband dies, okay? And so they, by nature, I mean, not just in bust, even in booms, they invest in high quality bonds like treasury bonds and AAA corporates and in A corporates. I mean, that's what they do. And so that favors them, especially in these, what I call them winter seasons, when you have a deflationary downturn and all other financial assets go down. So they are conservative by nature, and also they're dealing in things. I mean, as the baby boom ages, you know, they're just going to spend more money on this type of stuff as well. People are not going to pull back as much on that as they do on cars and a lot of, you know, entertainment spending and stuff, you know, that they do. So life insurance, the only sector of the whole financial services industry that really did well in the 1930s in a deflationary winter season like I'm talking about were the life insurance company, not the health insurance, although they have some advantages too from aging baby boomers. The life insurance industry did well. So that's a damn good industry to be in.
Yeah, I agree. I agree. And that's, it's where I keep a lot of my capital is in that industry, just because, I look at like people like Walt Disney, who started Walt Disney World because of, the company he was with, New York Life. He had capital, everything else bottomed out and went to nothing, but he was still able to do it. Sears and, God, there's so many of them. But, another thing too, that I don't want to keep it too much longer, but your newsletter. Can we just talk a second about your newsletter? And because I've gotten tremendous value, you have a free newsletter, don't you?
We have a free weekly newsletter, harrydent.com. Just put in your email address. We have a paid newsletter, which I think is Dent, capital DENT 25. You get a 25% discount. I think it's like 180 something instead of 250. And 250 is cheap. The marketing people made me that we used to charge $400, But they thought 250 is a better price, and I'm fine with that. I want more people to do it, but that is very inexpensive for what we're giving people. That's so contrary and so timely.
Yeah, I've gotten, just you mentioned TLT. Well, you did, I don't remember what, newsletter it was, but you were talking about TLT and that, and, the buy signs, and you had a buy sign, and I jumped on it, and I've been doing fantastic with it. It's more than paid for my entire newsletter for 3 years down the line. So it's just little things like that. Everybody is so caught up in what, they're so scared to get out right now. Cause like, oh, everybody's getting in. But when everybody's rushing into something, it's a pretty damn good indicator that you should be rushing out of it. If Warren Buffett's pulling out, kind of quiet, but certain people are noticing, like, why is everybody else rushing in? And why can't they just understand that if they just took a timeout, or put some money in treasuries and some of the things you're saying, or just sat in cash and waited for this opportunity when things do drop? It could be as early as you just mentioned. Like, what is the difficulty in people's mindset with just waiting, taking a time out? Because that biggest buying opportunity, like you said, of a lifetime is right around the corner.
Well, people watch their neighbors and they do what their neighbors and friends. That's just people are. That's what they do. So they do. And the most people pile in at the end. When the most people are bullish and piling in, there's a lot of indicators for that, and they're all off the charts as usual. It is the worst time to get it. I tell you that the guy who got it best was the simplest. 1929, Joseph Kennedy, multi-millionaire, okay, in today's terms. He became a billionaire political dynasty with just the common sense insight that the shoe shine boys are talking about stocks. I better get the hell out. It was no more, he wasn't, the price earnings ratio is at 29.4 and no. Shoe shine boys are telling me what stocks they're buying. I better get the hell out. And that's all he did. He got out in 29 and back in the early 30s and bought business and stuff. Again, he millionaire to billionaire off of that one transition in the economy. And I'm telling you, that sort of transition is very likely coming. And there's very, very few people going to have the guts or the insight to tell you because it's just politically unacceptable. Nobody wants to think about it. Politicians are telling you every day. Warren Buffett's even saying it's okay while he's selling. Quietly, so you just have to have common sense and say, I'll tell you the difference between smart money and dumb money. It's the same simple principle. Smart money, the longer they see something go up, like stocks or real estate, the more risk they see. The dumb money, the everyday person, the longer they see, this is a trend I can bank on. Well, some things are like that, okay, like evolution, okay? Financial markets are not like that. The longer they go up, the closer you are to a big downturn. That's the truth about it.
It's hilarious that you mentioned that about the shoe shine story with Kennedy. And also in 1929, after we had a first blip, who was, and you'll probably know her name right off the top, who was that famous stock picker, that woman who said the stocks are going to go to the moon? This is in 1929, the same exact time the shoe shine guys are telling Kennedy, all this stuff. And he's like, well, if they're talking about it, that means I probably should get out, and became a billionaire, not a millionaire, because he just did the opposite. Do you remember who that was? I put a video on my Facebook.
I don't remember that lady, but the best known economist of the time said, right, 3 months before the stock market crashed, stocks had reached a permanent plateau of prosperity. When you hear that, you should run. When major experts are saying, we've come to the point where stocks can never go down. And you know what, Janet Yellen was pretty much saying something like that not too long ago. We might see something, but I don't think we'll see another financial crisis in the rest of our lifetimes. And I'm like, that is the dumbest thing I've ever heard an economist say. Sorry, Janet.
Yeah, I wouldn't listen to a word.
Running our Fed, she's the head of the Treasury, for crying out loud. And people are saying stuff like that. They know, like Jim Cramer would say, they know nothing. And you can't say that if you look at history, financial cycles. That's what they're saying. Oh, permanent, oh, we got a new trick, and now the markets never have to go down again. If we did not have market crashes, if we did not have recessions and depressions occasionally, we wouldn't have one honest, productive person or business left in the world. You have to have your ass kicked up now. People become complacent. People follow their neighbors. More and more people going over the cliff. They just go up the cliff with them, okay? That's what people do, okay? It's not the right way to think when it comes to investments. You've got to be more of a contrary thinker, especially when something's gone up this long.
Final thing I got to get your opinion on. So I hear this all the time. Yeah, but Chris, if I sell my blue chip stocks that are huge companies now, I got all this capital gain that I got to pay tax on. That just doesn't seem smart. What would you say to that? I know my answer, but this would be
first of all, they're talking about raising the capital gains tax to ordinary levels, going to double it or more. So better to pay the lower now, better to pay the lowest tax, capital gains, while you have gains before they disappear. So that's faulty reasoning too. You're going to have to pay tax. It doesn't pay to lose money to avoid paying taxes, okay? That's the way doctors think, you know. Well, I got all these schemes where I'm losing money, but I get tax deductions. Well, you're still losing more money than your tax deduction, okay? I'm sorry, because your taxes, unless your taxes are 100%. So it's just, you know, that sounds good, but no, doesn't make sense to think that way. You've got to take your gains while you have. And the fact that you're taking long-term capital gains at, let's say, roughly 15 is maybe 20 or 20, depending on what state you live in. I'll tell you the best way to do it, move to Puerto Rico. That's where I am. You know what my capital gains tax is? 0. You know what my income tax is? 4%. You know what our state income tax is? 11.5. So what I do, I buy a lot of crap on Amazon.
The surf is pretty good in Puerto Rico, so I'll see you there eventually when the little one's older. But yeah, that's what I always tell people. I say, listen, I got a great strategy for you. If you're worried about paying taxes, here's what you do. It's easy. You'll never have to worry about paying taxes on your stock gains and all this. Just wait, hold those blue chips and all those treasured stocks, hold them, wait for the market to drop 30, 40, 50% and figure out how much gain you have. You're up 30%. Just when it gets down 40%, just sell all your stock. Now you got yourself a 10% loss. You'll never have to pay taxes. And hell, then you can carry the losses over to the next year and the next year. Perfect strategy. That's,
you know, there's a couple other creative things you can do too. You could have okay, a stock portfolio, and I've calculated this in the past. It'd probably be close. I haven't done it recently, but at about 3%, maybe 4 max of your portfolio, you could buy put options out, 6 to 12 months that would keep you from losing money when it went down. So you don't sell your stocks and have to pay the taxes. You cover your loss, so you break even on that. And that's another way to play it. Now it's going to cost you 3 or 4%, but that's nothing compared to insuring you against, say, 40 to 50% loss. And again, the whole loss is going to be bigger than that. But what I emphasize over and over again, and people never get it, it's the first crash. It is the hardest and the fastest. Same in 29, same in 2000, and same now probably. I'm projecting the first crash, which could be starting this week, for all I know, and looks like it increasingly, or sometime in the next so many months. That first crash, I am projecting today, will be 49 to 50% in 2 to 3 months. So that's not hard. If that's the possibility, wouldn't it make sense to bet, to could wager 3 to 4% to cover you from that loss and not have to pay the tax bill. So that's another creative way to do it as well.
I love that you brought up the options and the puts. You know, it's simply hedging, and it's something that everybody's going to learn tomorrow. They're going to learn how you can literally put these, I don't want to call them insurances, but it kind of is, you're insuring against downside loss. You can hedge your losses by just simply following some simple steps. They'll learn all about that tomorrow. I'm glad you brought that up. So in final words, I don't want to keep it too long, and I really appreciate your time. Is there anything you'd like to say to the audience, just kind of in a wrap up?
Well, you know, my most important thing, not just about economics, but life in general. Life is the play of opposites. You know, it's boom and bust. We want the booms and not the bust. It's male and female, and some people prefer males, some people prefer females. Okay, but you have to have both. It's that dynamic. It's inflation and deflation. Economists want to prevent bust. They want to prevent inflation or deflation. And those are the very things, the most productive investments, the most entrepreneurial creation happen in downturns, which we try to prevent. And in deflationary, inflationary periods, is the booms where those things just play out. The real seed, the birth of the baby doesn't happen unless two people have sex, which is also a play of opposites. So the play of opposites is the way to think about life. Appreciate it, the dynamics of it, and quit being like a baby that says, well, I want the good and not the bad. If you don't get your ass kicked, you're not going to learn much in life. End of story. And I've had my ass kicked a lot. Okay? People say, oh, you're successful. You live in Puerto Rico. You got all these. No, I've gotten my ass kicked a lot. That's where you learn the most. So appreciate that. You don't have to go looking for trouble. When you get a challenge or things go down, you ought to be saying, oh my gosh, I'm probably about to learn something big or have a breakthrough, rather than crying and well, I can't believe my stocks went down, or I lost money in my house. It's better to avoid that, but appreciate both sides of life. You can't have one without the other. That's the ultimate wisdom to me on anything.
Wow. I love that you said that, and the comments are coming in and people are loving it as well. And, you know, someday, I doubt it, but someday maybe we'll find our way back to Austrian economics, where it actually just allows the markets to crash and fall on themselves. We'd get out of these things much quicker. We'd have a much more productive economy, and we would just take our lumps and move on and be a hell of a lot better off. But
yeah, I'll end with one statement. That 2008 crisis, if they'd have let it go just another year and a half, we'd have seen the worst of it by now and been over it. We'd only had some minor recession. They'd have just let another year and a half of deleveraging and pain, we would have been long over this. Now we're going to have an even bigger crisis later. It's just stupidity.
Yeah, it is stupid. Well, Harry, thank you so very much. I'm going to put it up again in the chat so that everybody can get on your newsletter and learn what I'm learning every single week from you and Rodney. It's just amazing advice. And thank you for sharing your time with us today. I can't tell you how much we all appreciate it.
Okay.
Thank you. All right, everybody. I know you guys love that. There was a lot of questions that were coming in on that. But, you know, if you really, we did record that, folks. So we will send that recording out. It will be a separate bonus recording. I wasn't going to do that, but we did it because I want you to watch it over and over again. You know, there's a lot of information. You know, Steven probably was taking extensive notes. I know Duck V was taking notes as fast as he could. There's a lot to unpack there. That is not designed to scare the living shit out of you. It's designed to tell you the reality of the circumstances that we are in today. I played the Warren Buffett thing this morning, not as a filler, is because I knew that that is what you needed to hear. Because if Warren's doing a lot of the same things that Harry's saying, there's something going on here. And, you know, like I know some of you, and I'm not going to say any names, but we're saying, well, what do I do if I've got a lot of these really, really super high quality stocks? Do you mean Tesla, Apple, Amazon, Facebook? Just maybe it's some of those, these really great FANG stocks that just seem like they're never going to go down. Apple's such a great company. It is. Apple isn't going anywhere. But would you rather keep Apple and ride it down 30%? Because every single stock, I don't care what it is, will trend downward with a downtrending market. I don't care how good the stock is. I don't care how good the product is. I don't care what it is. They all go down when the market goes down. What did they say? The rising, you know, all things rise with the tide and fall with the tide, whatever that statement is. That's true with the stock market. So if you've got these great high quality stocks and you don't want to sell them because they're just so darn good, like what should I do? Sell them and then wait for them to go down 20, 30% and then buy them again. Oh,
Why wouldn't you want to sell them? Like, what is holding you on?
I don't know.
It's mostly psychology, right? Or emotion. So it's just
emotion. Well, my grandma gave these to me. I inherited them from my grandparents. They were very special. They loved this stock. The company's not going anywhere. Like, you can buy the stock back, but wouldn't you rather buy the stock back at 30% lower than it is today? Wouldn't that just logically and financially make sense? It would. It would make tremendous sense. But again, you know, and that's why I brought that tax thing up to him, because that's what I hear the most. I was on the phone with a gentleman worth several $1 million. Hopefully he's not on here, and I'm not going to say his name. And literally we're talking about it. And I'm just like, my gosh, you're sitting on, you know, all these stocks. You should definitely take some of these gains. I didn't say sell everything. I said, you should take some of these gains off the table. And he says, you're right. And I've been thinking about this every day. It keeps me up at night. I'm retired now. I can't really afford to lose this, you know, so I probably should. Next conversation. Well, I ran the numbers and my taxes, my taxable gain, if I sold these now would be X, and that just doesn't make sense. And I literally said to him, like, I didn't care if the guy never talked to me again, because I was kind of pissed off. I'm just like, you literally just said the stupidest thing you could ever say. And I said to him that thing that I said. I said, oh, great. Here's your strategy. Don't sell those stocks. I totally don't think you should pay tax. Just wait for them to go down. Would you say you're up 30% on that one? Wait till it goes down 35%, then sell it. And you won't have to worry about paying any taxes. You'll have a carry forward loss, and like, life will be good. And then you can't ever say, oh, I don't want to pay taxes again. And all of you I know are listening to this saying that's idiotic. It is, but like, listen, you might think that's idiotic. That's what people are thinking. And it makes no freaking sense. And, you know, Harry's out there, you know, he probably doesn't have to do what he's doing, but he feels, and I know what's going on with him because I feel the same way. He has to ring the bell. He has to be the sounding board to let people know that this is coming, because otherwise the euphoria will drive everybody off the cliff, or at least the 95%ers off the cliff. And people keep asking, you know, well, what do I do in my 401k? Do I liquidate it? Absolutely not. You really, like, don't liquidate your 401k. In other words, don't close your 401k out, reallocate it within the 401k so you don't have to pay taxes. It takes nothing, to cost you nothing to go in, take you 10 minutes, reallocate your portfolio. Every 401k portfolio will have a cash option or money market option, or it will have something like a government bond or a treasury bond option. Like, that's not the same, but if that's all you got, that's a pretty good place to kind of park it. Then future money going in, keep buying the riskier assets, keep buying those micro caps, those small caps, those large caps, because when it does go down, you'll be buying it as it goes down. Remember what Warren Buffett says. I say this all the time: buy low, sell high, don't lose money. Don't buy high, sell low, and lose money. You know, I was on Duck V's show the other day and somebody said, Chris, if we would have listened to you a year ago and got out, we would have missed out on this whole uprun. I was kind of laughing inside, because I'm just like, really? Like, what uprun? Oh, I would have missed out on all that gain. The market really, I know everybody thinks it's gone up tremendously, like in the last year, but you really need to look at it. It hasn't gone up straight up, but like, if you really look at the gains, if you rode that thing down 35%, it took you roughly 47% to get back the 35 you lost. So once you got back, how much are you really up? 10%? Maybe you're up 20%. Like, is that worth it? Is that worth the risk of what is coming, the headwind we are facing going into it? I don't know. Maybe for some it is, but for me, call me an idiot, whatever you will. But listen, like, I like buying things cheap. And if I have the opportunity to buy things cheap, like, you know, Jade said, sold Amazon, you know, like, great. Yeah. Like, Amazon's really high. Most people would say Amazon's not going to go down. Everybody uses Amazon. Amazon will go down, and you will be able to buy it on sale, and like every other stock out there. And the treasuries he mentioned, like, we didn't get into it, but study US treasuries. Just study the inverse relationship of how a bond works. You heard him say 30 to 40% upside potential. Why? How can you make 30 to 45% on a guaranteed US treasury, 30-year treasury? You have to understand the dynamic of how they work. And they are one of the most liquid investments you ever can put your money into. So when everything goes down and everything's drying up and people don't want to, buy stocks or anything, if it ever got that bad, they're going to want treasuries. And guess what? If you buy them now while they're cheap, because when the market goes up, treasuries are getting cheaper and cheaper. And subscribe to Harry Dent's newsletter. And I'll put it up on there again. It's quite simple. You guys can just Google it. Holy smokes, look at the comments here. I wasn't able to keep up on all these. Okay, I can't get back to the beginning, but anyway, it is harrydent.com. And listen, that's the free newsletter. You'll get emails, read them all. I print them out. I put 3-hole punch them and I put them in a little green 3-ring binder. And then I just go back and I read them and I do Facebook Lives on them. Whatever your methodology is. But one thing I would suggest, pay the $189 for the year for his paid one, because then you get his rants and you get a whole bunch of other stuff that you don't get with the free one. And listen, I get nothing for this, folks, like nothing at all. I just pay it. And because I pay it, I bought TLT and many other things that he said, and I've acted on a lot of things, and it has been dead right. So folks, I hope you guys enjoyed that bonus session. Let's just get the rest of these questions. And then I want Stephen to kind of close it out. Would you please explain why you believe Bitcoin is going to lose so much value? So, okay, this is one I knew was going to come up. Whether I believe or don't believe Bitcoin's going to go down in value, Bitcoin's trending with the market. Bitcoin will come down in value. Spencer said it's going to come down in value. Spencer isn't investing for Bitcoin in the short term. He has a belief that it's going to be worth $1 million. That's his belief. For Spencer and for most people investing in Bitcoin, you shouldn't care about these ups and downs. Like I know a couple of people bought the last dip. Kudos, that was awesome. You should have. But you got to believe where it's going. You got to believe in the problem that it solves. And if you believe in that, it doesn't matter where you buy it. If it's going to $1 million, does it matter if it goes from 53 or wherever it is today down to 4 and then gets back up to $1 million? Not at all. Not at all. I'm going to start buying Coinbase, but I'm going to do it slowly. I'm just going to dollar cost average in because I definitely think it's going to go down. So why is Bitcoin going to go down? Because all things will go down. And Bitcoin, although a lot of people want to believe that it's like the next gold, it's not. Gold will go up when the market goes down. Bitcoin, probably not. But is Bitcoin a good long-term investment? I think absolutely. Harry Dent thinks absolutely, but he won't buy it at the price today. He'll buy it when it goes low because he's a bottom feeder. That's what he does. That might not be your strategy. So if you're buying Bitcoin, don't stop buying Bitcoin. Just look and develop a strategy and make sure you believe in the problem that it solves. What treasury can we buy other than TLT? That's a great question, Doc. The treasury, just go to the government website. You can buy treasuries direct from the treasury. And you can buy 20-year treasuries or 30-year treasuries. The TLT he mentioned is just easy because it's on every brokerage. It's just an ETF and it trends, them. But you're gonna pay a little fee to have that convenience, if you will, of that ETF. But how else can you get treasuries? Well, most 401ks have some type of a mutual fund with a treasury backing. I think they have to. I think they have to have something like that, or buy them direct. If you got enough money, then I would definitely be buying direct. I really would. Cut the middle person out. I bought TLT just because it was easy on my TD Ameritrade account to do that. Let's see, is gold stock different than buying gold? Of course, is buying a piece of paper versus having a block of gold in your hand or a gold coin, is it different? It's very different. But am I saying that one is, that much better than the other? No, I mean, I've been buying gold mining companies and I've also been buying gold. Harry Dent is more treasuries, which I've been also doing, but other economists I listen to are more gold bugs. So again, if you listen to enough economists, you're going to get different viewpoints on them all, but they're all saying the same thing, maybe just different paths to get there. That's all. That's all. So I do that research for you. I pass on what I know, and I hope that benefits all of you and helps all of you, make the right decisions for your goals, for your family, and for where you're going. Every one of you are different. Every one of you are going to take one of the things you learn in this 3-day or 2 or 3 of those things, and you're going to apply it, but it's going to be different for each one of you. The only thing I hope is that no one on here does nothing. That would be a travesty. That would actually literally upset me tremendously, upset Stephen tremendously, upset my whole team if everybody on here did absolutely nothing because of, whatever paralysis by analysis, we'll call it. So folks, I hope you guys like that. That wasn't easy to get him on this, not at all. And you know, it was really phenomenal. So Stephen, how would you like to close this down?
No, it's been an awesome day. Like we were saying before Harry came on, I mean, the Inner Circle is an amazing event. And I mean, the best part about it, let's face it, it's live, it's in person, it's, you know, being with each other again. And after the last year plus of being, you know, for a lot of people in different states, not like Florida, you guys have been in isolation, you know, so just being able to get back out there with other people and be around other people. And, you know, that's always been the most powerful way for events, is the networking, the shaking hands, the breaking bread together at dinner. That's always going to be the most powerful way to build a relationship. And as we've been saying since yesterday, this is a business of relationships. Chris, I don't know how you got Harry Dent, but I assume it's through your relationships with mentors and
100% how. Absolutely how. Yep.
And what you've done. And I mean, you've met, you know, Dr. Vaughn on here. You met him at a live event mentorship. You know, Spencer that was on earlier. You know, I could go on and on.
Mastermind.
Yeah, I mean, Kevin Shortell, I met him at a mastermind in Phoenix. So I think
Arizona mastermind. I can't remember the name of it. It'll come to me. I think it was Noteworthy or it was something like that.
I was with you at that one. And I remember meeting Kevin prior to that at other events. And so it's on and on. So, I mean,
that's all I remember with the sprinklers. Oh,
yeah.
Yes.
I actually sat there talking to all the speakers the whole weekend, as opposed to being in the ballrooms, because that's what I do. I build relationships, and I still have contacts from that event outside of Kevin even. So it's just that's where you really build this business and you start building for the future. And so I'm super excited that we can do Inner Circle again. It's going to be a live event. It is in Buffalo, New York at the Money School headquarters, which is a really cool event. Right where Chris is now. So you get to see where the magic happens. So that's an incredible event. For those of you that aren't ready to travel yet, or you can't make it to Buffalo, you know, if you need any assistance with anything, like I said, we got that 6-week virtual coaching program coming up in May for private lending. That'll have a lot of really good information in it. We got the private money club where we're going to support and help you through MSTV and our group monthly mentoring. So, you know, join us if you like this stuff, you know, and then don't forget, we got a whole day tomorrow. I was just looking at the lineup for tomorrow. I mean, we're starting out tomorrow, first thing, 10 a.m. Eastern, going into exactly what Harry just finished with, which is the money you do have in stocks, how to protect it.
Yes. Isn't that awesome?
I didn't even plan that.
I listen, I've never once heard Harry Dent talk about puts and hedging. And he literally started talking. I don't know if you saw me, I sat back and I kind of like put my head back. I'm like, are you kidding me? The first speaker tomorrow. So make sure you're up. And I know some of you, that's 4 a.m., but believe me, Sodi is going to go deep into how to hedge and get ready for this. Some of you don't want to sell your stocks, and that's your prerogative, but why don't we hedge against those losses? Why don't we make sure we got some insurance for the downside, so when the market drops, your treasured stock that you don't want to get rid of is protected and you're making money by hedging. Exactly what Harry Dent just said. I couldn't believe that.
Yeah, no, it's absolutely awesome. I mean, you know, I've seen our speakers and I get more and more value every time I sit through one of these and listen to them, even though I know I've heard Spencer, I've heard Brent, I've heard Kevin speak, you know, 100 times at this point, probably, but I love it. Every single second of it. I mean, my wife and my son were out in the sandbar today with some friends out in the boat, hanging out in the sun, but just that part of the end, listening to Harry made the entire day worth sitting here with you guys and just being able to have these conversations with you next week and get you started with IBC policies, get you started in the private money club, connect you with the different funds and the different lenders, and just helping you, you know, create something for the future. It makes every second of it worth it. So thank you very much for being here, guys. I mean, I love it. And Chris, thank you for putting these on. I mean, I know you have a young one at home as well. And, you know, sitting in the office all day on the weekends, probably not ideal, but it's worth every single second. And I know in the future, it's going to pay off in dividends, and giving back is what it's all about. So it's been a great weekend so far, and tomorrow's gonna be even better. So it's awesome.
Absolutely. And I look forward to seeing each of you tomorrow. We got a heck of a day planned for you. And then we've even got another bonus session tomorrow. So if you are worried about paying taxes, remember Brent was talking about filing the 1041, Your bonus speaker tomorrow is equally as valuable as Harry Dent was today, because you're going to literally learn trust foundations and one of the biggest secrets of the wealthy. Why did the Clintons, the Donald Trumps, all the wealthy of the world not pay the same amount in taxes? You will learn exactly why tomorrow at the bonus session. So folks, we will see you bright and early in the morning tomorrow, and we'll be here with the bells on. So until then, have a good evening.
Have a great weekend, guys. We'll see you tomorrow morning.